market that thrived without transparency. For years, the most powerful signals in London were the ones you couldn't see. Not prices, not headlines, but absence. Some markets grew precisely because they were hard to observe. They expanded in the gaps between disclosure and understanding, and they flourished while attention was elsewhere. To see why this still matters, we need to understand how opacity became an advantage. Because entire financial ecosystems were built to operate beyond clear sight, and their influence has never disappeared. As regulation increased in visible markets, activity did not slow, it relocated. Capital found routes with fewer questions. Structures formed where oversight arrived late, or not at all. These spaces were not illegal. They were undefined. And definition is where accountability begins. Participants value discretion over clarity. Transactions happened privately. Prices were negotiated, not displayed. Risks circulated without public markers. At first, this flexibility seemed efficient. Fewer constraints meant faster movement. Customization replaced standardization. But invisibility carried another benefit. It reduced comparison. Without reference points, behavior was harder to challenge. Markets like this did not compete on transparency. They competed on access. Who was allowed inside? Who was not? Over time, these hidden systems grew larger than expected, not because they were superior, but because they were quiet. Silence protected margins. Privacy protected leverage. And complexity discouraged inquiry. What emerged was a market that didn't need to be understood publicly to shape outcomes globally. And once influence detached from visibility, control followed a different logic, one that rewarded those comfortable operating unseen. As these markets expanded, their invisibility became normalized. They were no longer exceptions. They were infrastructure. Participants treated opacity as a feature, not a flaw. Private negotiations allowed tailored risk. Bilateral agreements bypassed public scrutiny. Exposure moved without leaving footprints. This created speed. Deals closed without signaling intent. Positions adjusted without alerting competitors. Information stayed contained, but containment changed behavior. Without public pricing, feedback weakened. Without benchmarks, discipline softened. Risk was assessed internally, not collectively. Each participant trusted their own models. Few questioned how assumptions aligned across the system. The absence of visibility produced confidence, not because outcomes were safer, but because consequences felt distant. Regulators struggled to see scale. Fragmented data hid concentration. What looked dispersed was often aligned beneath the surface. These markets interacted with visible ones quietly. They hedged. They amplified. They transferred pressure without detection. During calm periods, this integration seemed harmless. Hidden activity absorbed shocks efficiently. Volatility appeared reduced, but reduction was an illusion. Volatility had not vanished. It had been stored. The larger these invisible markets grew, the more they shaped visible outcomes. Prices moved in response to forces no one could trace. Participants trusted that discretion protected stability. That privacy reduced panic. That silence prevented contagion. But silence also prevented early correction. Imbalances accumulated unchecked. Feedback arrived only when thresholds were breached. By then, adjustment was no longer gradual. It was abrupt. The market thrived without transparency because it postponed accountability. And postponement, while profitable, always carries a cost. The cost became visible only when pressure returned. As conditions tightened, these unseen markets reacted first, not publicly, internally. Private calls replaced public signals. Margin demands rose quietly. Agreements were rewritten behind closed doors. But these adjustments did not stay contained. They leaked outward through connected institutions. Liquidity was pulled from visible markets without explanation. Observers saw effects without causes. Prices moved sharply. Volume spiked. Confidence weakened. Because no one could see where the strain originated. Every participant assumed it might be everywhere. This is the danger of opacity at scale. When stress arrives, invisibility spreads fear faster than facts. Institutions exposed to hidden markets face a dilemma: disclose connections and trigger panic, or remain silent and hope stability returned. Many chose silence again, because transparency felt destabilizing, and because opacity had worked before. But hidden leverage behaves differently under stress. It does not unwind smoothly. It snaps. Positions that relied on private assurance suddenly required public liquidity, and public liquidity was unprepared. The invisible market had shaped the visible one for years. Now it demanded support without explanation. This reversed trust instantly. Markets no longer feared what they could see. They feared what they could not. Uncertainty multiplied, not because risk increased, but because its location was unknown. What had once thrived quietly now destabilized loudly. The very features that made these markets attractive, speed, privacy, flexibility, became liabilities under pressure, and the realization spread quickly. A system cannot be stabilized if no one knows where stress resides. Transparency had been treated as optional. Now it was demanded urgently. But urgency arrived too late, because once confidence breaks, visibility cannot be restored instantly. It must be rebuilt, slowly. When the hidden market finally surfaced, it arrived without context. Connections were exposed after they mattered. Dependencies revealed themselves only once strained. What regulators and participants discovered was unsettling. The system had grown reliant on what it could not observe. Transparency was not absent by accident. It had been traded for efficiency, for discretion, for speed. But efficiency without visibility is fragile. It performs well in calm and fails suddenly under stress. London's financial system did not collapse because of invisibility. It destabilized because invisibility had become foundational. Markets cannot manage what they cannot see. They can only react to its consequences. The lesson was not to eliminate private markets. They serve real purposes. They absorb complexity. They allow customization. The lesson was balance. Opacity must have boundaries. Privacy must not erase accountability. Today, transparency is no longer just regulatory language. It is a stabilizing force, a way to distribute understanding before fear takes over. Systems that endure are not the quietest. They are the ones that can explain themselves under pressure. London's markets continue to evolve with this knowledge, not perfectly, but consciously, because power no longer belongs to what stays hidden longest. It belongs to what can withstand being seen. The market